You know, every time you buy fresh fruit from across the world or you step on a plane to cross an ocean, you are relying on one of the most complex, most powerful pieces of technology ever made. It's the unsung hero of our entire global economy, and it's hidden away inside an airplane's wing. And right now, in 2025, it's in the middle of a crisis. So, what's causing all this trouble? Well, the answer might actually surprise you. It's not a lack of people wanting to fly, and it's not a shortage of new plane orders. Nope. The biggest bottleneck holding back global trade and travel is our strained ability to build, and even more importantly, to repair the very engines that make it all possible. And here's the thing. This entire high-stakes global ecosystem is dominated by an oligopoly of just three titans. We're talking about GE Aerospace, RTX's Pratt Whitney, and the UK's Rolls-Royce. They don't just compete with each other. They literally define the physics and the economics of modern flight. All right, so to get to the bottom of all this, here's our game plan. We'll look at the Titans themselves, we'll dive into their paradoxical performance in 2025, we'll uncover where the real money is made, look at their strategic pivot to Asia, and finally, check out their big bets on the future. So let's kick things off with the players. And I want to be clear, this isn't just a market. It's more like a multi-decade chess match where every single move, from designing a tiny turbine blade to signing a massive service contract, has global ramifications. Okay, so let's see how these giants have carved up the sky. First, you've got GE. Through its partnership with Safran, they are the undisputed kings of the narrow-body market. You know, the workhorses of aviation, like the Boeing 737s and Airbus A320s. RTX's Pratt & Whitney is their main rival in that space with its really innovative geared turbofan engine. But when you get to the giant, long-haul, wide-body jets, well, that's Rolls-Royce's kingdom. They power an incredible 4 out of 5 wide-body models that are currently in production. Now let's talk about performance, because this is where things get really, really interesting. On the surface, business is absolutely booming. Flight hours are way up, order books are full. But if you dig into the 2025 financials, a paradox emerges. Record demand is clashing head-on with some unprecedented operational and supply chain problems. Let's start with GE Aerospace. After spinning off its other divisions, it has become an incredibly lean, mean, efficient machine. Get this. In 2025, it generated over $800,000 in revenue for every single employee. That's not just a number. It's a testament to a super high-value, surgically focused business model. Then you have Rolls-Royce, which is really the comeback story of the year. After years of struggling with debt, they executed this massive turnaround. They ended 2025 not just out of debt, but with a nearly $2.5 billion net cash position. That is a stunning financial reversal. But that positive story from Rolls-Royce, well, it contrasts pretty sharply with the situation over at RTX. I mean, they have a massive backlog of orders, but they are dealing with a colossal headache. This negative $1 billion figure, that represents the cash they had to burn through in 2025 just to compensate airline customers for a critical quality control failure. This chart really tells the tale of 3 very different companies. So let's take a minute here. If we look at the segment profit margins, for example, GE is just cruising at an incredible 26.6%. Rolls-Royce, after its big transformation, is at a very healthy 20.5%. But look at Pratt & Whitney, RTX's engine division. It's squeezed all the way down to just 7.9%, and that's largely because of that quality issue we just mentioned. Now look at the capital structure. GE is rock solid, Rolls-Royce is sitting on that pile of cash, but RTX is under some serious pressure with a much higher debt load. Every number here tells a piece of a much bigger story. So what exactly is this crisis? Well, it boils down to something called the powder metal matter. A rare flaw was found in the specialized metal powder that's used to forge these supercritical engine parts. The problem is, those parts are now inside hundreds of engines powering the really popular Airbus A320neo. The result? Airlines have had to pull planes out of service for emergency inspections, creating this massive global traffic jam at repair shops that were already running at full capacity. And this brings us to the industry's big secret. You'd think these companies make all their money selling brand new engines, right? But that's just the start. The real long-term profit comes from the aftermarket, servicing those engines for the next 20 to 30 years. It's the classic razor and blades model, just, on a multi-billion-dollar scale. And if you understand this, you understand the whole industry. The tool they use to do this is the long-term service agreement, or LTSA. So when an airline buys an engine, they often sign a contract to pay the manufacturer for every single hour that engine is in the air. In return, the manufacturer handles all the maintenance, all the repairs, all the spare parts. For the engine maker, it's a dream. It locks in guaranteed, high-margin revenue for decades. For the airline, it creates predictable costs, sure, but it also locks them into a single service provider. Just look at GE for a perfect example. A staggering 70% of their total revenue in 2025 came not from selling new engines, but from these service agreements. This, right here, is the financial engine that truly powers the company. And this strategy is absolutely universal. Rolls-Royce, who actually pioneered the whole power-by-the-hour model, sees 69% of its civil aviation revenue coming from services. For RTX, about half of all their future contractual obligations are tied to these long-term maintenance deals. So the crucial point here is this. Controlling the repair shop is every bit as important as controlling the factory floor. And that brings us to a major strategic pivot that's happening right now. For years, China was mainly seen as the world's biggest sales destination for new engines. Now it's transforming into the world's most critical repair hub, a nerve center for servicing the massive and still growing Asian fleet of aircraft. And you can see this strategy taking physical shape across the region. Rolls-Royce is doubling down with its world-class facility in Hong Kong and a new joint venture in Beijing, locking in that service revenue for decades. GE's hub in Taiwan is the operational backbone for thousands of LEAP engines in Asia, and RTX's center in Shanghai is a vital support node for its GTF fleet. They are all planting flags to secure that incredibly lucrative long-term aftermarket revenue. But this pivot comes with some pretty unique risks. RTX, with its enormous defense contracting business, is actually facing direct sanctions from Beijing. This creates a really complex and potentially fragile environment for their commercial partnerships over there. And all three of these titans are wary of U.S.-China trade tensions, which could restrict access to the rare earth minerals that are absolutely essential for modern engines. Okay, finally, let's look at where this high-stakes competition is headed next. The next battleground isn't just about efficiency or reliability. It's about decarbonization. It's about the revolutionary technologies that are going to completely redefine the future of aviation. And here, you can really see their different philosophies in action. GE is making a moonshot bet on its RISE program with a radical open fan architecture that looks totally different from today's engines. Rolls-Royce is developing its UltraFan as a flexible, scalable platform that could one day power both wide-body and narrow-body jets. And RTX is taking a more conservative, iterative approach, improving its already successful GTF engine with the Advantage model. Three very different bets on the future of flight. But there is one thing they all agree on. The most immediate path to reducing emissions is sustainable aviation fuel, or SAF. And every single one of their next-generation engines is being designed from the ground up to run on 100% SAF, which shows a pretty unified industry commitment. So if we pull this all together, this quote from HDIN Research perfectly captures the state of play. The game has changed. For decades, the goal was to win the next big sales campaign. Today, the most pressing strategic challenge is just unclogging the global repair network and delivering on the promises they've already made. Which leads us to the final question. In an era that's defined not by a lack of demand, but by a lack of capacity, who wins? Is it the most efficient operator, the one with the healthiest balance sheet, or the one with the biggest backlog? The answer is going to shape the future of how we all travel and trade. This analysis was based on extensive research from HDIN Research. And just a quick reminder that this explainer is for informational purposes only and does not constitute financial advice.